price of silver could potentially explode if gold comes under more buying pressure. Can you elaborate and go into this?
Yeah, Shane, and particularly in the case that the gold for oil trade expands from its current friends-only deal into a global market offering of cheap oil for gold. Now, really then the demand for physical gold will force Basel III compliant over-the-counter gold to be physically delivered in sufficient size to feed the multi-trillion-dollar oil markets at a huge, irresistible discount. Then the non-NSFR compliance of silver will backfire on the professional trade that the LBMA talk about, and the LBMA seek to reassure in that episode, really as the price of physical gold easily doubles into Zoltan's assumptions. Now we're talking about leverage here. So to answer the question, Shane, why is this important for silver? I guess is the question. It's true. It's due to the silver's openly admitted highly leveraged status, and they've admitted 100 to 1. Industry apologists talk about 500 to 1, somewhere in that number, which is huge. And when you think about it, it's ludicrous. That's significantly higher than gold. So the prospect of doubling the spot gold fixed price is a huge issue for joined at the hip silver, likely tripling, quadrupling, or even larger the price into a bid-only market short squeeze. Now, with this $60 capped oil price currently pegged to a single gram of physical gold, it just happens to be a gram of gold, what, $60 or thereabouts. The contention here is that if Russia opens up its oil market by openly exchanging potentially unlimited quantities of $60 cap barrels of oil to anyone who has physical gold to trade for it, then as Zoltan suggests, sweetening the deal for the same gram of gold and providing more oil for that same gram of oil, then this race to buy physical becomes a major threat to the banks shuffling paper gold inside the central bank K-Bal contained synthetic range. Now that sanctions have been imposed by the G7, it is to Russia's advantage to strategically double down on the already existing largely Indian oil for gold swap, which should be going on anyway, instead offering 2 barrels of oil pegged to each gram of gold. Now think about the implication of that. The bargain will be impossible to ignore in the global markets, and the race to buy immediately deliverable physical gold to exchange for oil will force the price of gold to literally double. Now, he estimates 3,600. Well, that would be a doubling, roughly. But more highly leveraged silver, joined at the hip to gold, will almost certainly hard test the 50s. Now, not only would this double down strategy bolster the value of Russia's central bank existing stockpile of gold reserves, which is almost certainly, if not a primary objective, a secondary objective of such an offer. But it also obviously allows them to continue to generate and sell oil. But the sudden unfactored increase in the dollar price of gold bear in mind, we're talking about into a Basel III compliant over-the-counter spot market, once again exposes the COMEX-centric EFP imbalance. Now, bear in mind, we're talking about EFP is simply the exchange for physical, where you've got a paper market in the COMEX, able to exchange that paper market into the over-the-counter market, which is Basel III compliant, so therefore becomes deliverable. Now, this imbalance between Basel III compliant deliverable spot gold foreign exchange positions, they're currently 1-to-1 hedged against a COMEX short position. So obviously, if we see this fracture occur again, we're going to see a March-like EFP fracture. We've been through that multiple times, and how we saw suddenly $80 to $100 differences, higher price to get out of those positions to avoid delivery by buying back your short positions on the COMEX. Bear in mind that we're talking about liquidity. It's a 10 times larger market in the over-the-counter market. Now, obviously, they're trying to balance this. They're not stupid. They're trying to balance this. But this time, like last time, there was a central bank rescue. This time that's not feasible, as the over-the-counter spot market is now fully NSFR compliant, which it wasn't the last time we saw this blow up. So let's just see how this game has changed for gold. So at the margin, and always at the margin because of this leverage situation, and this answers a lot of questions. Despite spot gold being NSFR compliant and the paper to physical structure improving dramatically, which it has, although muted, the game has continued. Now, for hedging purposes, which is long spot gold positions, they have an offsetting COMEX short position, so they're technically compliant. This is how the CFTC and the regulators say that's fine. Well, because they consider it to be compliant. But these so-called hedges are structured upon a carefully calculated supply of deliverable physical gold that is able to be called on for delivery on demand. So they try and calculate that. Namely, this trading balance, we'll call it a balance, is determined by how many of these NSFR compliant long over-the-counter positions can be paper squared against the COMEX-centric speculators who can be relied upon to never take delivery inside the COMEX casino. That's why we were talking about this earlier as to how that occurs. And this is where the tail risk to a Western central blowback is exposed. And as we've identified, the slowly rising stair-step ranges that we've been witnessing in gold are determined by how much of the short load can be laid on the speculators. And we talked about this multiple times. And by financing these heavily leveraged spec positions, the optimum point that specs can be rinsed of their naked long or short positions is the actual balance point between the paper and the physical markets, i.e. how tight the unleveraged or physical wholesale market is weighed against the highly leveraged COMEX-centric synthetic action. These are the footprints that the insiders cannot hide from the wholesale market. And given the primary house insiders holding the book on spec loaned positions, in other words, the specs have loaned it from these guys, they know where the pain points are. Obviously, they've got up to the minute, they're privileged to have up to the minute information on exactly where the maximum pain point is. And they're able to ensure the maximum number of hedged positions can be profitably squared without exposing themselves to physical delivery obligations. Now, clearly, this is a much more muted game, but explains, although the ranges are a lot more shallow, this explains how they are gaming the stair-stepping higher ranges. Now, if the K-Bar managed stair-step rising price of gold suddenly breaches through these insider cap ranges, triggered by a March 2020-like shortage of physical gold to meet a sudden surge in demand, whereas before it was COVID-related, there were no refineries open, now there's simply a shortage of physical, then there will be a race to cover into an increasingly bid-only paper market.